I'm relatively bullish here. I just think the bottom line is, look, we just had the 50 best trading days ever in the history of the stock market, and you're going to get some profit taking along the way. And I think that's what you saw yesterday, and that probably added to a little bit of panic selling as well. But the bottom line is, look, you have more government stimulus around the world than we've ever seen before. And the bottom line is the economies around the world are getting better. You start looking at China's PMI numbers, they're going up again. Their demand for industrial metals is going up. So I think all the market really cares about long term is things are getting better, getting worse, and they're clearly getting better right now. And I'm hard pressed to think that we're going to go back to the lows. It's a pretty aggressive statement from where I'm standing, Dominic.
All right. So Lindsey, I'm curious then. There's a reason why markets reacted the way that they did yesterday. No doubt it's been a sharp run higher. But what exactly was the precipitating or factor that really caused the market to sell off as sharply as it did yesterday?
You know, I think it was a couple of different things. Of course, the case count increasing in certain states played into a factor into that, and that's been happening for over a week now. So the market finally took notice of that. The Fed, obviously, the day before coming out while still being dovish. The outlook remains pretty bleak. And so I think it was just really it's just a reality check for the market yesterday. We did, like Ryan said, we came very far, very fast, up 13% in the last month. And the market just started to feel a little bit more frothy. I think if you look at some of the internal indicators like breadth and others, you started to see that the market felt like it was getting a little bit stretched. Today, though, you see the market popping significantly, at least here in the pre-market. You never know what's going to happen throughout the day. But I think what it tells you is that there is still a decent amount of uncertainty in the market. So volatility has returned in a way. And I think it's something that we're going to continue to see until we at least get more economic data and get to second quarter earnings season in July.
All right. So Lindsey, let me follow up with that with you right now. So Lindsey, if that's the case, then what exactly is going to be the biggest factor that affects the future direction of this market? Is it the COVID-19 hospitalizations and infections count? Is it earnings momentum? What exactly does drive the rest of the market for the next 6 months?
Look, I think the market's going to be choppy, at least from here until, like I said, probably until second quarter earnings season. And so I think that the market could react to different headlines as we get them. But I really think that the technicals are once again taking over here. You saw over the course of the past month, the hope for a reopening really driving that upside in the market. And now I think we're getting back to technicals driving the market because we're going to have limited amount of data points and we're going to have limited information coming our way. So the market's going to look towards technicals. It looks like the market's sticking with and around the 200 moving day average on the S&P 500, which is 30.13. After that, 29.55. That's the level where we were at through much of April and May. That could be a level of support going forward. But ultimately, I do think there's enough support in this market from the Fed to support levels where we're at least near today.
All right. So, Ryan, let's turn to you for the shopping list. What exactly then? We've had a pullback. Stocks are relatively on sale from where they were about a week ago. Tell us what exactly you would be looking to buy given what we've seen right now.
Yeah, absolutely, Dominic. And I think first off, you want to look at this as a correction in a bull market, right? You're going to hear a lot of the headlines right now talking about how finally the market's coming back to reality with the economy. And I would say don't do that. This is a great time to buy because you don't get these opportunities very often. And you just talked about cyclicals, and cyclicals have had a great bounce off the bottom here. If you start looking at things like consumer discretionary, materials, energy's had the biggest bounce of any sector off the bottom, dramatically outperforming technology here. So I think you would really want to start to buy the stuff that's been beat down a lot. And you talked about small caps. Well, small caps typically outperform when you're in a recovery. So I'm an asset allocator for our clients. We're trying not to put everything into big tech, which is really getting overvalued. I mean, Amazon now trades at 100 times forward earnings. It's getting like crazy. So I think it's really important that you start to spread that money out. International looks good as well. You're getting valuations there. They're very, very attractive. So my shopping list has all the beaten down sectors and all the asset classes that haven't performed well but are starting to perform better since we bottomed back on March 23rd.